All right, good morning. Welcome back here to Trader Running. Great to have you aboard. Market here this morning set to open up about 25 points lower. And you can see S&P futures, here last night. And, they're drifting a little bit higher shortly after the market closed. And then they get this sharp drop right here. And then fairly flat, another sharp drop as European equities open up, and then been kind of grinding back ever since. But what's going on? What happened? Well, two things went on right here on this drop, and I noticed most of the media outlets kind of blaming this on Chinese economic data, and they have validity. There's validity there, but also we saw Janet Yellen speaking. And she is the former Fed chair, and she talked about the Dodd-Frank Act and how deregulation is threatening to trigger the next financial crisis. And, we saw futures drop on those comments. Now, they were coming out as some of the Chinese data was coming out, so which one drove it? I think both have a strong foundation for argument there. But we have both of those going on where, Janet Yellen warning about deregulation and what that's going to do to the banking system in terms of its macroeconomic impact. And then we had some China data here with retail sales. And let's see if I can bring it up here if I click the right button. But industrial production, retail sales, this came out, and you can see retail sales came in at 8.1% year-over-year change, which was another little bit of a slowdown. Here in the U.S., 8.1% growth would be phenomenal, but again, this is China data, not U.S. data, but not the same. Not the same growth rate that has been. You can see the overall slowing that has been over the last couple years here in China growth, right? And it's still phenomenal growth, right, that most economies would, do anything for. But it is slowing growth. And again, as we talked many times, it's a second derivative world. Chinese industrial production, it grew 5.4% year-over-year change, but not what was expected. It was expected to be higher. And so, again, this whole concept of slowdown. It's not growth going into contraction. It's the pace of growth slowing. And that's what we saw in the economic data out of China last night. And so we saw this data come in at 7 o'clock my time, or 7 o'clock Mountain, which is right here. Right here. This is where the data came out. Okay, so yes, there's reason, there's validity to say, hey, you know what, it's China data, but some of this was really happening with Yellen's comments. But either way, right? Either way, it's one of those where we know what's going on, and it is a situation where global slowdown is feared, and whenever there's a little bit of evidence that it's happening, we are seeing the market react. Now, PIMCO came out this morning with some comments that I found to be really good. I found them to be really wise, really solid in terms of what this environment is, and how investors should react and what the environment is going to be going forward. And it's one where they came out and they said investors should keep powder dry and look for specific opportunities. Right? So just really specific, not broad-based market type of opportunity from an investor side right here. They said, we believe equity markets will remain volatile, favoring cautious positioning overall, and a focus on high-quality defensive growth and minimal exposure to cyclical equity beta. What are they saying there? They're saying buy AT&T and Verizon and forget about Caterpillar and IBM. Okay, They're saying basically forget about the Microns of the world and the Microsofts of the world. They're basically saying you need safety. They basically say that, they caution that the next recession, right? And they use this word, it will be the derating of financial assets rather than traditional macroeconomic overheating, which is really interesting because most recessions are created as you see the economy overheat and then it cools down and you get this cyclical element. We haven't seen an overheated economy here. So if we go into a recession, this will be one of the very few recessions ever where it doesn't happen after a real overheating of the economy. Some would argue, well, there's been overheating of the stock market. Okay, great. You can make that argument. But we haven't seen that overheating in the economy come into play here just yet. And they said that basically it is a market where a recession could be driven by financial assets, which is kind of a chicken-egg thing, where, wait a minute, financial assets are going to cause a recession? Well, we saw a little bit of this, and it did come after some economic overheating, but we saw a little bit of this in 2007, 2008, where the collapse of financial assets actually created the recession, were a big part of creating the recession. They're basically saying that that's the environment now, that's where the risk factor is now. They go on to talk about, different things and whatnot, and they talk specifically about the utilities and consumer staples sectors. And these have been two very safe haven type of sectors. In fact, if I bring up the chart here, you can see, utilities, they're trading at new highs. Consumer staples, they have been flying on high here in outperforming, Pepsi's of the world and whatnot. Have been doing very, very well in this environment. But they show that these two sectors, the utilities and consumer staples, their valuations are at 30-year highs. 30-year highs. That's pretty incredible. We've talked about Pepsi over and over, how it's incredibly overvalued right here. Now, overvalued doesn't mean it has to drop, but overvalued is is pretty pretty easy to see when you look at it fundamentally. But, it still is getting bought up as, overvalued, or overvalued is a relative term in the short run, and investors are seeing dividend yields that still are not achievable with bonds, and so they are running to these as little bits of safe havens. And I found their comments very, very intriguing from an investor standpoint. Now, we have another firm that came out this morning and basically said investors are underinvested right here and they're going to miss out big time. You better get in or you're going to miss the boat. So there's always a million different opinions. But I think from a person managing their own investments, I think PIMCO's words were very, very wise in terms of, hey, forget about the broader market right now. There'll be a time. There will be a time, there will be a shift, and there will be a time. But continue to focus on specific assets, specific stories instead of the macro, because the macro is going to continue to create an environment of heavy volatility. And, from everything we see, I suspect they are right and that we will continue to see some of that. In fact, when have you woken up to a morning where the market's gapping down 20 points and you wonder, I wonder if the market will end green today, right? And it wouldn't take a whole lot. Yesterday was a light trade range and it was still almost 40 points in terms of from the high to the low. And, the average true range on this market on a day-to-day basis on the SPY has just been phenomenal. Been a big change from what we had been seeing, over the last few years. In fact, the average true range on the market right now is over 50 points a day. So high to low on the market, its average per day is 50 points. So we look at a 20-point gap, a 30-point gap up, 20-point gap down. They're not even breaking above or below average true ranges. The way, back in 2017, 2016, we get a 20-point gap. Whoa, what's going on? Something major is happening. Not these days. In fact, look at the volumes yesterday. The volumes, for what this market is, very light, type of volume there, as we noted yesterday. But anyway, that's what's going on here this morning. Is there a lot for investors to sink their teeth into otherwise? No, there's not. There really is not a lot for them to kind of look at and grip and go, okay, I like this, and let's go. So it's going to continue to be the same type of environment that we've seen. And I'm going to approach it the similar way with the challenge. Now, yesterday I had to sell my BABA just because, the implied volatility crush on that was going to be too great and, wasn't able to hold some gaps. And, it's set to gap down about $4 this morning. I'll be taking a look at it for an entry. That's an intriguing spot. But again, I'll err on the side of caution given some of the option values. I'm coming into the day with cash and then VXX, and basically VXX has to close below 39 to have value, right? And any close below 39, if it's 38.80, it's worth 20 cents. 38.60, it's worth 40. 38.40, it's worth 60 cents. So, and it's one of those where VXX, obviously is going to gap up with the market gapping down. But this isn't a huge gap for it. And we could see easily, it dropped $2 from here. It could rally $5 from here. We talked about the possibilities, and, this isn't a trade where I'm jumping in and predicting or trying to do anything like that. It was risk reward. And, I'll take it off at the close of the market today if there is some value in it. Other than that, I'm going to let it go, and I'll be focused on where to add some cash. Now, I've mentioned that, I do suspect that the risk of a wow type of event is high, and that hasn't changed. That risk factor hasn't changed here. And, if we get that today, if the market S&P is down 120 points at one point today, yeah, I'll step in. And I'll probably step in pretty aggressively if we see that. I'm not expecting to see it, but if it does come to fruition, I will look to take advantage of that. Other than that, I'll be looking at places where where I can expect the stock to outmove the option, and where I can expect that we're not going to see some consolidation here overall. There's not a lot that's kind of just screaming at me right here at the open. I do want to see how this open plays out. I don't think this is a big enough catalyst to drive a continuation on the open. But in this market, it doesn't need a catalyst, to continue on lower. So we'll be looking and kind of assessing where some of the chart positions are, here as this morning unfolds. I would like to get some cash into play here, but at the same time, I'm not going to do that over, just sacrificing, some of the quality or getting into something of, lower risk reward, which is where a lot of things really are out there. Pepsi is one that is on my radar right away this morning, with its gap down. And, this is one where, how I feel about it. I think it's tremendously overvalued right here. Is it something that has to fall? No. But, with its recent moves that it's made, it does look like it's creating a topping pattern. Problem with it is the topping pattern could take the stock up to 120, 122. So I have to be cautious of that. But if it's able to break below 117 here today, I do think that is a very interesting one. And it's one that I've been willing to be patient waiting for an entry because I expect it to sell off tremendously. I don't expect a small pullback. I expect it to have a pretty large pullback. And so I don't need to, I don't need to sit here and go, oh, well, I got to catch it here, here, here. I can wait for a more critical breakdown in the daily chart. Thanks for hopping on. Have yourselves a great day, and we'll talk to you later. Take care.